What's up? I just did a video on Wyndham, the hotel chain, and it looks like it's pretty beaten down. Alex, what's up? Looks kind of appealing. And now that I work for a real estate developer, I'm the controller. I've been doing that for 5 weeks. I understand it a little more actually about the company than I did before I worked for this real estate developer. I can tell you what I mean, but let's look at the high level before we get into the nitty gritty. So lodging has done really well. Marriott and Hilton, since like 2021, they've gone up like 300% or so. I think maybe one of them went up 400%. I did a video on these 6 lodging companies. I just finished Wyndham. So I did Marriott, Hilton, Hyatt, H World. That's a Chinese company. Choice Hotels and Wyndham. So you would think like the way Marriott, for instance, makes money is they people go to the hotels, right? They pay a fee to stay per night, and then they go to the bar, they go to the restaurant, or whatever the amenities at the hotel. But actually, that's not how they make money. Most of these companies don't make money from people staying at the hotels, because that's why it's really important, I think, to understand how a company makes money. Before like investing in a company, you should really understand like what they do, because they actually don't operate hotels. Marriott, same thing. Coca-Cola doesn't really sell soft drinks. Pretty much, I mean, especially Wyndham. Wyndham is like 99% franchised. But even Marriott, most of the revenue is from franchisees. So they just sell the idea, the concept. So you can buy a Marriott hotel. You have to buy it from Marriott, and they obviously help you build out the hotel. And then you run it. You operate the hotel. So you have to do everything yourself. And Marriott, they just collects a fee, a royalty, usually like 8% or 10% of gross revenue. Hey, Godskin, what's up? And because if you wanna operate a hotel, you could do that. It's a free society. You just have to apply for the license and you have to build it. That's not easy to do. I've never heard of Wyndham. Oh, you really? Yeah, it's not a big one. It's not a big chain. It's not like Marriott and Hilton, but I'm sure when I show you their brands, I'm sure you've heard of some of the brands. Okay, so here are the brands. So Wyndham is only maybe 10% of their chains. You might have stayed at a Days Inn, a Super 8, a Howard Johnson. They all own these chains. La Quinta. I guess those are the big ones. I've never heard of Registry. That's like their deluxe. That's like their Ritz-Carlton is Registry Collection Hotels. Then they have Dolce, another upscale. I never heard of that either. But maybe the smaller ones you've heard of. Howard Johnson or Travelodge, Days Inn, Ramada. Maybe you heard of Ramada. Yeah. It's just like when you see a holding company like Berkshire Hathaway. Like most people have heard of Berkshire, but if you didn't know who Berkshire was, you probably know who Geico is, because they own Geico. It's kind of like this, they own a lot of kind of not subsidiaries, but they're all part of the umbrella company, the main company, Wyndham. But Wyndham has a number of hotel chains. hotels itself with that name. Like when I was looking at the I wouldn't have known this without working this job, but when I was looking at the they show the free cash flow for the first quarter. So 100 million of free cash flow. And we all know free cash flow is operating cash flow minus capital expenditures. So operating cash flow 76 million, capex 9 million. But then there's this, they have a $31 million payment of development advance notes. And that's something I learned at the place I'm working at. So when you buy into the franchise, the Wyndham franchise, the reason you buy into it and not open up a hotel yourself is because they'll do it for you. They'll help you build the hotel. They know how to do it. Obviously, you have to pay for it. It's your responsibility to pay for it, but they'll organize. There's a lot of parties. There's obviously a construction company. That's the big one, but there's a lot of different engineers. Like for instance, I can't remember the name of the engineer. Maybe it's an environmental engineer. But for instance, a certain engineer has to look at the soil underneath the ground and make sure it can hold a hotel of that size. And if it can't, then they have to either do something to the ground to strengthen it, or the way they have to build the hotel, they have to build in a certain way and with certain structure and beams in order to keep the integrity of it so it doesn't fall down. So there's a lot of like parties involved. There's a lot of different types of engineers involved. And then you have to have like so many different people, like people who put in the windows, the doors, who you have to buy beds. It's just the list goes on, and it's not easy to do. It's not like if you wanted to open up a little convenience store in your town, that's like so much easier. You just need like some refrigeration and, and supplies. But, there's a lot of like licenses you need to build a hotel. So anyways, so they do this for you. That's why you buy into the franchise, Wyndham. And they kind of, with your funds, they'll help you build it. But they charge a development fee. So it's usually, I think, 5% of the project cost. So I think it costs like 1.5 million to develop a hotel, or at least their hotels. So Wyndham will take a development fee because it's their time. Maybe $75K per hotel they help build. So that's what this is. It's $31 million. This is an advanced note on development fees. So that's like a cash inflow for this company. I think they show you the cost right here. So if you wanted to invest into this franchise and you wanted to operate a hotel yourself, this is the costs. So cost per room. Obviously, it's so dependent on a lot of things. This is an average. So the cost can vary quite a bit depending on how many rooms, depending on the location. And then things change, you hire a construction company and then they don't finish a job and you end up suing them. So you have to find another this all adds to the cost, but this is just like a general amount, an average amount. So say you wanted to get a little hotel in your town. Say your town is kind of popular. It's right near a big city, so a lot of people visiting the big city. Maybe you're not in San Francisco. You're in a suburb. So people always visiting San Francisco, and you're real close. So you wanted to get a 50-room hotel, and you could. Obviously, they have a lot of different types of hotels. You can get an economy, so it's a pretty low rate per night, or you can get a luxury. So roughly it's $75K per room. So if you wanted to get a 50-room hotel, that's kind of high. 3.8 million. I wonder if they 1.6 million. I wonder if this is. It's actually not that high. It's about. If you were buying a home, a personal home, you could get lower than 7.25%. But these big loans are much higher, and commercial loans are a lot higher than residential loans. So I've seen a lot of even with good credit, 9-10% for these large commercial loans. Because even for the reason home loans are so cheap, at least the interest rates are so low, is because you live in those. So those are kind of like you'll take care of it more than if you live in a home. Your livelihood is in that home. Commercial, it's not as, you just might find someone who is buying different commercial properties, so you're not as worried if you lose the property. Okay. 30. Yeah. What are 30-year mortgages? Aren't they like close to 6%? They're almost 8%. That's a regular home loan. Sheesh. Maybe down to 7%. What's up, Chris? But even if 7%, so you're almost 8%. The rates have come up a lot. But even if you bought a home, even if you wanted to get a home loan, but your home is very expensive, they call those jumbo loans. Jumbo loans tend to be a little higher. So jumbo loans, 7.17%. Well, what was it? I remember when I got 3% on my mortgage, and I paid off my mortgage when it was 3%, and people were like, "Why did you do that? You'll never get a rate like that." I was like, "Well, I didn't have a crystal ball to predict rates were to go up. It was a decade of low rates, and I wasn't really doing it for investment. I was doing it like a peace of mind thing, just so I don't have to worry about that debt." So yeah, so they were, and I got 3%, and I was like, and I thought that must have been in 2017 when I got 3%, or 2018, because I bought the home in 2015 and then I refinanced. But I thought to myself, they'll never get this low ever again, and it actually got lower. I know some people with me. Well, talk to my wife. She doesn't really feel that way, Alex. But thank you. That is very nice of you. So they touched 8%, which is crazy, right? But you know there was a time in the early 80s when people were paying almost 20% for a mortgage. I think it peaked at like 81, 18.5%. Like, could you imagine? Could just think, like, nobody could buy a home. I mean, unless you were super rich. But the best time to buy a home actually is when rates are really high. The higher the rate, the better time to buy a home, because the price of homes moves opposite rates. So as rates go up, home prices go down in order for people to afford to buy a home. And as rates come down, home prices go up because people can afford a larger and larger home because interest rates are lower. And the reason you want to buy a home with high rates is because then you refi when it goes down. You can't, if you buy a home with low rates, that means you overpay for the home because you're buying it when it's inflated, right? And then you can't refi because you have the lowest rate. So you're just stuck with a low rate with a really expensive home. Wait, 150. Wait, committed suicide in 2000 due to mortgage sales because of the ANZ Bank. What is that? Are you Dutch? Isn't that, wait, ANZ Bank? Oh, no, that's New Zealand. I'm thinking of Netherlands. So people committed suicide. Yeah, I could believe it. In a report, New Zealand, yeah. Is it because people? Is it like? Did the rates reset on the loan? Is that why? Like they were paying like $1,000 a month for their mortgage, but rates reset, so they were paying $2,000 a month, and then they. But that's how you feel. Like, say you have. Government loans. I mean, I can believe, because say you have say it's the year 2000. It doesn't matter the year. In your portfolio, like the value of your assets, whatever you want to call it, say is like $100,000, and you worked like 15 years to get to that point, and you've been saving and you've been investing, and then there's a big crash, whatever you want to call it, a real estate crash, a market crash, but your assets go down dramatically from like 100,000 to 50,000. I mean, it could get so depressing, and it doesn't. When a market crashes, it crashes fast. Usually, it's like 2 months for it to go from top to bottom, and then it takes like a year to get back to where it was. And it always gets back and above to where it was, but it takes longer. Crashes are fast, rebounds are slow. So it's hard to. It's not like you went from 100 to 50,000 and then right back up to 100,000. It could take like a year or two, and it's just like so painful every single day, and it's that weighing down on you, and then you kind of give up on life. I mean, obviously, it's hard to like because you don't know the future. So you're always thinking, what if it never comes back? Even though it always does come back, but you're never really satisfied until it happens. It's kind of like when you meet somebody like you really like, even though you have a good feeling it's going to work out and they like you, you're never satisfied until like you get that confirmation. But yeah, but it's a painful process because it seems like no end in sight. You're just like drowning. So this is a 21 room. What I guess that's possible with 21 rooms. Exactly 21 rooms. So this is, I guess this is an average size hotel for them. So if you wanted to buy into this hotel franchise, the average, and say you want to get a 21 room, it's a good starter hotel, right? And then once you get bigger, because you can't just get a 500 room hotel unless you have $1 billion. You have to start somewhere. So yeah, 21 room hotel. It costs roughly $75,000 per room. That doesn't mean each room you spend $75,000 in each room. That means for the whole entire hotel, when you spread the costs amongst the rooms, because you have to build like hallways, you have to build parking lot, you have to do a lot of things, and you have to spend money that's not even in the hotel. You have to pay taxes, you have to pay insurance. So you need 1.6 million to invest. And even if you have 1.6 million, they want to see you have more than that. They probably want your net worth to be like 3 million, or at least like 2 million. It seems small, right? Average rooms. It's 10 to 500. Smaller boutique hotels may have 10 to 20 rooms, while larger resorts. I guess if you ever went to like a really popular destination, like I used to always go to Atlantic City all the time. And if you stayed at like Trump Plaza or one of the hotels at the casino, those hotels have about 200-300 rooms, but and they were expensive. But once you're driving towards Atlantic City, along the highway, there's hotel or motel, whatever you want to call it, after motel. Like there's just one after another. There's like probably 25 that lead up to Atlantic City. And those are much, much smaller. Like that, literally like some of them are 10, 15 rooms. Most of them, I would say the average is like 30 or 40. But they're much, much smaller because it's kind of a supply demand thing. If there's a way to make money, businesses will pop up, and not all businesses have a ton of capital to have a huge business to start. Lots of small businesses are out there. So I'll just go with their example. And I think that's what it means, because it says cost per room, $75K. Yeah, okay. So you have to invest 1.6 million to build this 21 room hotel. Okay. How much build a 100-room hotel. So if you're going to the average cost to build a hotel is $130 to $550 per square foot. Yeah, I guess it depends on the size. And they're assuming you're going to take a loan. Obviously, if you don't take a loan, you don't have to pay the interest, so you save that money. But most take a loan, even if you can afford it. Most still take a loan because you don't want to tie up all your money into this one investment. And RevPAR is revenue per available room. So it's pretty low end, $55. And this doesn't mean you charge $55 a night. That's a revenue spread across the available rooms. Because I think the average hotel in these portfolios, I think it's like 70% occupancy, what I've seen. I don't know if it's in this file. Yeah, so it's like 70% because you're not going to always fill up all your rooms all the time for a number of reasons. It could be, so obviously weekends you might be full, almost full all the time, every weekend, and holidays. But there's going to be a lot of during the weekdays that it's not full, and it's not just for demand. It could just be the plumbing. The toilet's broken in a room, so that room is out of commission for a week until that gets fixed. So for whatever reason, so that you may charge $90 a night, but you have to spread that 90 over your entire all the rooms. So it's $55 revenue per available room. Well, let's just see if we can back into it. So $55 per available room. Okay, so if we do, so 21 rooms. Okay, and so the number of days is 3. So 21 rooms. So there's 7,665 times you could rent out a room. Because I'm multiplying the number of rooms by the number of days. I guess revenue is not just, they don't make revenue. This is for the person operating the hotel, obviously. Part of the revenue is what you charge for the room. But I guess, I don't know how they come up with this, but I'll just go with their number. I'm sure it makes sense. So revenue for the year for running that hotel is $1.4 million. Operating expenses $770,000, and then you have to pay Wyndham a royalty of $119,000. I wonder. Which is an 8% royalty. 8.5% royalty. But I don't know, like this 1.4 million is not just how much people pay for a room. It also includes like if somebody maybe if they have like a little convenience area where you buy snacks, that includes like the snacks. It also includes if somebody makes a long distance call, every single expense that every single charge the hotel brings in. Maybe they stayed a little past. They have to be out by 9 a.m. They stay till 10 a.m. so they get hit with a $50 fee. I don't know. So the EBITDA, earnings before EBITDA, earnings before taxes, depreciation, amortization. Also, they're including the 266. So you're actually losing money because you get 247 of EBITDA, and then you have to pay 266 of interest. So you lose money. I guess, is that right? Earnings before taxes. Oh, no. It includes a 266. So that's why it's 247. It's inclusive of the interest. It's not stripping out the interest. So which I guess we can do the math here. My keyboard is not really working that well. Okay, yeah, 513, and then you pay 266 for interest, and then you get a 247. So it's a 16% cash on cash return. Oh, now I see. Now it makes sense. So it's not a 21 room hotel. This is your investment. Your investment is 30% because you're getting 70% of. You're getting a 70% loan. That's why they give you the LTV. Okay. So it would be, I guess it'd be like triple. Okay, so loan. Okay. So it would be more like a 69 room hotel. That's why we were like, it seems like a small place. I was trying to justify it, but it still kind of seems small. Okay. So $75,000 per room, and you're getting a loan you're getting a $3.6 million loan, and you're putting up $1.6 million. Okay, so do you guys know what LTV is? It's a pretty common term, but so the value of the is 5.2 million. That's the value of this whole project. 5.2 million. And it not only includes the build out and construction of the hotel, but it includes everything. Includes all these little miscellaneous fees. So the LTV, loan to value, you take the loan over the value of the property. Lifetime value. So, the lower the LTV, the better. Because say there's a home for $300,000 that you really want. The bank is not going to give you a loan for $300,000. You have to usually put 20% down. So the bank says you need to come up with $60K, and then we're going to cover the rest. So we'll give you a $240,000 loan to buy this home. So your LTV is 80%, and then you pay down your loan over time. Maybe in the first month, I don't know. Let's just say you always pay $2,500 a month in monthly mortgage payments. Say you did a 20. I don't know if the math makes sense, but it's 20-year loan. You got 7% interest. So the first payment, it might be like $800 of principal, $1,700 of interest. And this may be the first payment. And maybe like the 20th payment would be something like $1,100 of principal, $1,400. And as time goes on, you pay more principal and interest. So maybe year zero, this is your LTV is 80. Because you might apply for a loan, or you might you want to buy a car, for instance, and they're going to go, what's your LTV? And let's just pretend it's 2 years after you bought the home. So you probably paid down a little principal. Even if you didn't pay extra, you just paid your minimum, what you had to pay. And we could just pretend let's take a real life situation. Let's just pretend you want to buy a second home. So they want to know what's the value of your home today. So they look up the value. They compare it to other homes, and they see it's $330,000. So it went up $30,000 in 2 years. And you pay down $12,000 of principal. So now your LTV is 69%. So really, the lower the better. You want a zero LTV, so you don't owe anything. And you could pay more principal. Like I did that when I bought a condo in Staten Island. So every now and then, if I had a little extra cash, I would just call the bank up, or just send in more money. And just let them know, okay, I want to apply this towards principal. And we just knock down the principal. It's good to go through this exercise because now we know. Now it makes more sense. So yeah, so So the whole project's 5.2 million. You go to the bank, and the bank says, I guess in their example, they want 30% down. So we'll just stick with their example. So the bank says, okay, it's 5.2 million, the whole project. We can't give you a loan for 5.2 million, but if you put 30% down, which is 1.6 million, then we'll give you the other 3.6 million, and we'll charge you 7.25% interest. And let's see if we can figure out the revenue now. So we know it's 69 rooms. 69 rooms. Equals 69 times 365. $69 times 365 times 55. Okay, so this is good. Actually, it says help. Do they loan it out, or do you have to? No, I think pretty much any company doesn't give you the money. There's very few companies that fund these loans. You almost always have to go to a bank. There might be some really big companies like a McDonald's or another franchise that may loan money, but most companies, like this company, Wyndham, is not in a business to provide loans to people. They're in a business to build hotels and help you market the hotel and get in customers. So yeah, very few. That's a good question though. But it is possible. It does make things a little more difficult when you have money tied up into loans. Maybe car dealerships do that. If a car dealership owns a lot of cars, they may provide the loan. They have an arm, a lending arm. I know a lot of car dealerships have that. So now RevPAR of $55. So that's assuming, and I bet you these numbers are rounded because I'm at 1.39 million. They're at 1.4 million. So I think we're on the same page. So this is assuming all 69 rooms, if all, like, the revenue per available room is not how much they're charging. They're probably charging like $80 a night on average. But some rooms are vacant. So they're taking their entire revenue and spreading it out across all rooms as if they're being occupied every single day. Definitely, Alex. That's another benefit of going with a franchise. I mean, I was part of a franchise for 10 years, a math tutoring center. So the beauty of that is that there's like 1,000 mathnasiums. So we would have these relationships with different companies that like marketing companies, and they gave us a good deal, or companies that credit card processing companies, and they gave us a better deal because we gave them a lot of business. So like Wyndham may negotiate with a specific insurance company or a specific engineer and said, we can guarantee you X amount of customers, but you got to give us a little better rate than you would give anybody else. So instead of charging, $10,000 to build this fence, we guarantee we'll have at least 20 customers for you over the course of a year. So give us a 10% discount. So yeah, so this RevPAR includes all fees, any income the hotel receives, whether it's charging for food or charging people who stay there or charging for phone calls. It's taking all that income and spreading it out across every room as if it was occupied every day. So that's the RevPAR. That's a really common term for hotels and motels, RevPAR, because that's a good way to look at your how your business did over the year. Because even if you're charging more money per room, your RevPAR may have went down because you could be charging so much more per room. Like you could double how much you're charging people, but your vacancies go up a lot because it's less affordable. So this is not good. Their RevPAR only went up 1%, 1Q 2023 to 1Q 2024. They added 4% more rooms, so they added some more hotels. Well, possibly they grew some of their current hotels. But number of rooms went up 4%, but RevPAR only went up 1%. It's kind of gotten beaten down, this stock. But I do like, the reason I like it is because they're pretty much 100% franchised, which is a lot less risk. So yeah, so 1.4 million is a revenue. Then you have operating expenses. And that's the thing. Like if you bought into this franchise and you got a hotel, if you and your wife and your kids are the main employees of the hotel, of course you're going to make more money. Your margins will be a lot higher than if you had to hire people. Because if you have to hire a lot of people, it's expensive. You got to pay all that payroll. And in the first year or two, if you're not making money, you can take a low salary for yourself or your spouse until you become profitable. But you can't just ask an employee not to get paid until you become profitable. So yeah, it depends what you're doing. If you're looking for an investment, yeah, 16% margin is not that much room for an investment. But if you're looking for a business of your own, if you're looking to get, instead of working somewhere, you're kind of buying yourself a job. Although it's not a bad job, $500,000 of EBITDA, and then once the loan is paid off, right now you only get $250,000 after you have to pay the interest on the loan. But after the loan is paid down, then you get $500,000. So it's not a Wyndham. Wyndham. I'll be right back. Bathroom break. Okay. Now this is just if you want to buy into it as the franchisee, but they're the franchisor. So how do they make money? It's they royalties. So you may pay 5% of your revenue, or no, 8% of your revenue. I think that's what we calculated, to Wyndham for the opportunity to use their name. So they charge a royalty. That's the bulk of their revenue, royalties, but then upfront fees. So when you initially join Wyndham, like when you buy into the franchise, you have to pay an upfront fee. It's something probably could be like $50,000 or $100,000, like a one-time upfront fee. And then after that upfront fee, then you pay the royalty. But something that real estate companies get that most other companies don't get is development fee. Probably McDonald's gets a development fee. But if you buy into like a Kumon, do you know Kumon? It's just it's an English and math tutoring center. They're not going to charge a development fee because it's pretty easy to open up a business, a tutoring center. You just have to find a place to lease in your town, and then you just need to, paint and carpet it, of course, and just buy chairs and desks and a computer or two, and then of course you have to, whatever the curriculum, you have to get that stuff. But it's not much infrastructure. What I'm saying. Most franchises are usually pretty basic. There's not much development, but it's expensive and it's time consuming. It's not easy to build a hotel. You can't just ask someone, okay, can you build a hotel for me? You have to kind of manage that entire process, and it could take several months, maybe even a full year to build it. You have to get the land. You have to pay for it. Then you have to buy, the taxes. Then you have to build out that hotel, and you have to talk to a lot of different parties. So I think they charge, like say this project, is $5.2 million. That's the cost to build the average hotel. So they may charge, I think it's like 6% development fee. So that's Wyndham's fee, $300K, and they're not spending any money to do that. They obviously have employees that have to work on this to help, but they don't spend any of their own resources, any funds. They just kind of manage the process, help you get the hotel built. So the development fee, that's how real estate developers, part of how they make money is they charge a fee to build the project. And then if they do build the project, like the real estate developer I'm working at, we're building a project, and then we're going to put a store in there, maybe like a McDonald's or some store. And then that store is going to operate, and we're going to charge them rent each month. So some real estate developers develop a shopping center, fill up the shopping center with tenants, and then collect the rent each month. So they're making money every single month, kind of like a dividend payment. Alternatively, you can develop a property and just sell it to somebody else if you're not in the game of management. Because management, you have to, pay a company to manage a property, and then you have to maintain it. Things break down, which could be expensive. Obviously, if there's a lot of damage, it could be damage from just normal wear and tear. It could be a kid going, just trying to be fun, have fun, and like break the windows, or it could be a tornado goes through. So you have to maintain a property. Tenants are going to be calling you all the time. And then you have to, some tenants are a headache. Some tenants leave. They're not happy, so they leave. You have to find new tenants. So there's just different ways to make money in real estate development. It's interesting, right? It's who wants to? I'm talking to that guy Victor, and I see a lot of similarities with real estate development and hedge funds, like the fees, a lot of similarities. So if I start a real estate development company, do you guys want to be my first investors, or do you want to be partners? Just send me Amazon gift cards. Even though I pay all my contractors in cash, you have to send me Amazon gift cards. It's no logical reason to send me Amazon gift cards, but I needed to pay my contractors. I'm joking. Because somebody emailed me recently about wanted to buy my channel, and it looked like a scam. So I'm expecting them to say, just send me $500 in Target gift cards, and then I'll send you $10,000 for, if I send you 25, you gotta, right? Just send me. I'll email you a picture of these gold bars. This is a box of gold bars that I have that cost $1 million. And all I need you to do is send me $1,200 in Amazon or Target gift cards, and I'll send you the box of gold bars. And don't ask me, why can't I just sell some of the gold bars myself to get the $1,200? I could do that, but don't think about that. Just send me $1,200 of Amazon gift cards, and I'll send you the box of gold bars. It's so stupid. It makes no sense, but people fall for this stuff all the time. It's like I need you. I have $1 million in my bank account, but I need $1,200 to unlock the bank account to get the $1 million. So just send me $1,200, and I'll send you half of the $1 million. We'll split it, $500,000 each. That was fake. But it's just funny. I mean, it's sad, but I kind of get it, because you get your hopes up, and you kind of get pulled into the scheme, and you really trust the person. It's kind of like your best friend. You knew your best friend for like 30 years. You grew up with your best friend, and then they ask you for a favor, and it sounds odd, but you just trust them because of your best friend. And that's how people think. Like they trust a person so much that they're getting scammed from. They just they kind of latch onto it no matter what they say, because it's the same idea. It's kind of like your spouse or your mother asking you for $500. They need $500 to get surgery. But you don't question it, because it's your. That's how they kind of feel. But I got scammed out of $27,000. I really did. It's the video is it's scrolling at the bottom. It was 5 or 6 years ago I got scammed. So it was on my old channel. I used to have a channel where I scratch off lotto tickets. That's all I did. It was getting just too expensive to buy the tickets. So I just stopped doing that. But I made a video because my friend's, he has like professional equipment, and he makes videos. So he did it actually for free. So it's a pretty well done video. But you could watch it, how I got scammed. It's like, the stupidest one is like money flipping. I want to see flipping money scams. Like they ask you, send me, and they somehow convince people, and sometimes they do sound pretty convincing. Like they'll say, send me whatever you send me, whatever dollar amount you send me, I can add a zero. So if you send me $100, I'll send you back $1,000. Like they'll say they work at MoneyGram, or they work at whatever company. What's the company that sends money? Send money to India. What? Western Union. They'll say they work at Western Union, for instance. So if you whatever you send me, there's like this thing in the computer where I can just add a zero, and I could just send you right back. So whatever you send me, I'll add a zero. So if you want to send me 100, just to try it out, and then I'll send you back 1,000. And then some people say, no, I want to send 1,000 because I want you to send me back 10,000. Like they get so hooked into these things. Money flipping. It makes no logical sense. But then when you start like thinking about it, and when the person's explaining it, and sometimes they explain it so well, you start to think maybe it's true, because if he works at MoneyGram, he can just add to the computer a zero. Like you don't think logically, like where's the money coming from? Like how does this make sense? But did I get it right, or is that how they do it? I think I saw a video once on what's that called? What's that guy? That it was called like Scam Hotel. Something like, I think Hotel was in the name of his YouTube channel. Do you know what I'm talking about? Okay. So this is the kind of, when you start a business, if you want to start a business, it's the lower the risk, the better. So they're pretty much 100% franchised. I think they said 99% franchised. So of their hotels, Wyndham is 99% franchised. Same with Choice Hotels. Hilton is 89% franchised. Marriott is 76%. It's kind of like it's kind of like McDonald's and Starbucks. They're both really great businesses, right? McDonald's is about 99% franchised. Starbucks is 0% franchised. Chase is awful. God. And I worked at Chase in Manhattan for 5 years. Well, JP Morgan Chase. So both are successful businesses. I think anybody would agree McDonald's and Starbucks are really successful businesses. So is it better to franchise, or is it better to be an operator? Well, it depends, right? The lower risk is to franchise, because McDonald's doesn't have to operate any McDonald's. They operate a few, they own a few, but pretty much the vast majority are franchise. So somebody's operating them. And that's the hardest part of the McDonald's is operating it. Because you have to get employees, you have to maintain the employees, You have to manage all the customers. You have to buy food, cook food. McDonald's just collects a royalty payment from the franchisee, so it's kind of like a zero risk business. I know there's some risk, but it's pretty low risk because it's a pretty powerful brand, McDonald's. So they just collect the royalties from the franchisees. McDonald's is a little smarter than the average franchise, so they make a lot of money on real estate. But so I'll just ignore that fact, just in my example. But a franchise model is a great way to scale and grow, because they don't need to come up with the funds to open up stores. Because each store is like, what is it, like $2 million to open up a store? They don't need to come up with that money. They can just find franchisees to come up with the money. Starbucks, on the other hand, has to come up with all the funds to build all the stores, not just to build the stores, but they have to staff the stores. They have to maintain the stores. They have to buy product when it's low. They have to respond to customers. They have to pay the bills. It's a lot of work. And obviously they have a whole team of people. They have a team of people who are managing they have a team of people at the corporate level who are not even managing the stores. They're managing the people who are managing the stores. Like they have hundreds of people managing the stores. And then they have all the people who are managing the stores. They're managing people beneath, it's just, so they have a whole great infrastructure that they built, and it's very successful. But it's risky. It's much riskier to be responsible for running these stores. Quality control makes things a little difficult. It's the franchisor's responsibility. Like when I was part of a franchise model, they had to visit every year. They would visit my store, make sure I was up to code and all that stuff. And you're always going to have people that bend the rules, and then people who just aren't successful. But that's part of the. But the reason I like Wyndham is they have they're pretty much all franchise. So that's why when you look at their margins are so much higher than like a Marriott. Like it's very profitable business. You don't make as much money like Starbucks makes a ton of revenue, probably more than McDonald's, because they have to operate all their stores. McDonald's revenue is much lower because their revenue are the royalties, not the sales at the stores. So Starbucks, much higher revenue, lower margins. Like maybe not totally, but per store or per dollar invested, Starbucks has much higher revenue than McDonald's. But Starbucks is smaller, but it still might have more revenue. So 36 billion of revenue for Starbucks. Let's see McDonald's. McDonald's has less revenue, and McDonald's is a bigger company. McDonald's is 186 billion market cap. It's half the size. Starbucks is half the size with 50% more revenue. But their margins, Starbucks margins are much lower because they have a lot of expenses. McDonald's doesn't really have, the expenses are pretty low. They just collect the royalties. So it's been beaten down, Wyndham, and I think they have higher margins, more growth potential. So that's pretty much what I look for when I invest in a company, is a company that has scalability, that can grow and has high margins. because revenue is not nearly as important as profits. If you have really high revenue, like a supermarket, and really low margins, it's hard. It's just a lot harder to grow and scale. So what do you guys think? So is there any other stock we should take a look at? And lodging stocks have done really well the past couple of years because there's been a big surge of travel. I'll just show you like how Hyatt. I'll just stick to the two big ones. Okay. So in 5 years, so 5 years ago was right before COVID. So from May 2024 to current, Hilton is up 122%, Marriott is up 87%, and this stock is up 29%. In the past 2 years, this stock is down 13%. Marriott and Hilton are up 35 and 40%. So you want to buy when stocks are low, you want to sell when they're high. This has been lagging. So I think it's due for a rebound. So what do you think? LifeMed. Anything can go up 50%, anything can go down 50%. But if you invest in things at their all-time highs, it's probably not the best time. Like I'm saying, probably. There's no like definitive. And if you're investing in things at their all-time low, it could be a good time. But people think the opposite. People think, well, if it's at its all-time low, then it's going to keep going lower. And if it's at its all-time high, it's going to keep going higher because they think it just doesn't end. It has to keep going up or it has to keep going down. But you'll find that stocks can't go up forever, down forever. Of course, if it's a really bad company, it will eventually go to zero. If it's a really good company, it will go up over time, but it can't just go in a straight line like NVIDIA. There's going to be pullbacks every now and then. Okay, so LifeMed, 320 million market cap. This looks like a reverse merger, LifeMed. Was it like it was like a shell company? When you see this, it's likely it was a shell company and they just acquired them to go public. It really went up initially. That's what I'm saying. Like if you keep buying as it's going up, it's probably not the best strategy. You want to buy when it's coming down. As long as you identify good companies. Like this company is probably not a good company. You know, it may take a while for them to prove themselves. But if you find a really good company like an Amazon, like those types of companies, and you keep buying on the dips, you make a lot of money. Of course, buy and hold is good as well. But it's just like with Meta. When I talked about Meta when it was at its all-time highs, people listened. But when it was getting low, when I talked about Meta, they were like, well, it's going to keep going down. The companies are struggling. They may go bankrupt. Like people go to the extremes. They'll never, when a stock is going down, it's very rare. People, the majority are going to go like, you're right. This is a good deal. They're just going through some tough times. Okay, LifeMD provides easy online access to board-certified doctors. Okay, so this is a what's it called? There's a lot of these companies. That you can access doctors. You do all your online doctor visits and even bigger companies are getting into the game. But there are some companies like this one that are always Teladoc. That's the one Kathy Woods likes, right? Teladoc. Isn't she invested a lot in that? But Alex, Amazon, you don't realize Amazon doesn't make that much money in e-commerce. It's not that good of a business. The reason their stock is now $1 trillion or close to $2 trillion is the cloud business. If they didn't get into cloud, they'd just be another eBay. eBay is a great company, makes a lot of money, but they're not $1 trillion company. They never will be. It's half of Amazon's cash flow is from the cloud, and it's only like 10% of their revenue. And they have AI, they have all those things going on. But if they were just a regular a pure play e-commerce company like eBay, they would just be maybe 100 billion. They started out a pure play e-commerce company, but they've evolved. They did a. I like eBay. I think e-commerce is a great business. It's better than a retail store. That's why, like, the biggest companies by far are companies that have massive scalability. Apple, Google, Meta, Amazon, and NVIDIA. NVIDIA was a real surprise to me, but Apple is unique in a sense that they make something which isn't the most scalable type of thing, but they make phones, and phones aren't that expensive to make and scale. Making cars and airplanes are very expensive to make and scale, but they also have a lot of services, and they have so many customers, and they have a very loyal fan base. I should have put more into Apple. I just never saw it. Microsoft is great. Apple, I don't think it's as good as a Microsoft. Nearly as good as Microsoft. Yeah, so these telehealth companies, there was a big boom for telehealth for a while, right? Especially during COVID. And I really like the business model, but I'm not totally sold on the scalability and all those things. Telehealth companies. Is Teladoc the biggest one? Yeah, ARC owns 10% of Teladoc. I bet they lost a lot of money on this, because I think she kept buying even at like the higher levels. So this was it wasn't a SPAC. 2015, but it was really slow movement. It took COVID to push them up to the next level, but now they're below COVID levels. So what does that tell you? Okay, let's get back to the stock you suggested. Okay, LifeMD. I like to look at these kind of things, and I'm not saying this is how I decide on a stock, but I want to learn about as much as I can. So I think seeing who owns a stock, it just gives me some more info. And if I see the CEO owning like 20% or even 6%, it makes me feel better. It's just one check mark in their box when I see the person who started the company still highly invested in them. Like Elon. He's co-founder of the company Divisadero. I think that's in San Francisco. Because Divisadero is a popular street in San Francisco. Invesco. Look at I thought this had Rolls Royce. BlackRock 0.72. Okay, that's interesting. So why do you like this company? Did something happen, Robert, with the company? Or you just been following it? So they have it undervalued, simply Wall Street undervalued. 5 analysts priced this at 13. So if you want to see analyst recommendations, so in 2022, two analysts had it at $16, even though it was trading at $2. They priced it at 16. And then you can see over time the analyst projections. I always like to see the revenue historically. I just want to see if they've grown. Usually it's, if you see really big jumps in revenue, it's usually acquisition. Most companies can't grow organically at these levels. Like the only company that's grown organically at a massive pace is Apple. Like they're like the best company in terms of growth. They don't acquire really, like they have no goodwill on their balance sheet. It's amazing. It's all organic growth. Yeah, Divisadero, it could be just a street. It could be a street in other cities too. But it's possible if you grew up in a city and there was a popular like store or popular neighborhood, and then say you move somewhere else, like another country, another state, and you start a business, you might name your business after that street or store, just like if you like the name. That's possible. So LifeMD, let's see if they have any future growth estimates. Oh, they do have free cash flow, only 9 and 14 million. Let's use that. Let's see what they. Look at that, my calculated stock price. Look how close my stock price calculation is. This is interesting. They're trading at 784, and my DCF model has them at 795. That's pretty cool, right? But let me see the WACC. Let me see what the WACC is. $10.5%. Okay, let me use this WACC. Okay, if I use, let me use. So I'm pretty much right where they're, which is interesting. And once I get the real basic, the high level information, like where they're trading at, who their investors are, I think a good thing to do is go to investor relations on a company's website. And if you're not super comfortable with reading financial statements, I think investor presentation is helpful because it kind of lays everything out and it's a little easier to read. It's a lot bigger, the font, there's colors and there's charts. So visually, it's a little more appealing than just like a row of numbers and small numbers in black and white. Building, okay, 915,000 virtual meetings or appointments, whatever you want to call them. 235. See, I think this is one of the more important numbers to look at when you look at a company. Like when you're looking at a company like Meta, or not Meta, but maybe Meta in its early days. Look at how many users, or in this case, patients, because it's an indication of the future. Because like when Netflix had 50 million members, even if they weren't making money, like that's an indication they're probably going to make money. Like when you have such a huge base of customers, you don't have to just sell your product. You could sell marketing space, for instance, or you can sell another product. You can have a company, you maybe find a similar company. Maybe if this is a medical company, you could find a company that sells, I don't know, Band-Aids or something related to medical, and they market on your website, and then you get a cut of those sales, or you just charge them a fee to market. Revenue guidance, 205 million. So that's pretty good because they went from 37 million to 90 million. Not much jump in 2022. Like it almost tripled from 2020 to 2021. And then it grew like 20%. You would expect growth to be pretty more exaggerated in a time like this, when we're just getting through COVID and people are getting more into telemedicine. 150, so that was a better growth, but 200 looks like a nice number to hit. Yeah. See, this is all true. 1/3 of Americans don't have a primary doctor. And it takes forever. The wait times these days is long, 20 days to wait. So having access to somebody online, especially if you don't have insurance or your insurance isn't that great, you can't afford to pay like, $1,000 a month, even if you don't go to the doctor. You can just go once a year to the doctor and spend a few $100s at a place like this. It's a big market, as we know, 170 billion addressable market. So they do weight management. Okay. Percent of consults. So you say start on time. There's no wait. Pretty much every consultation is on time. Different conditions they treat a lot of conditions, 200 plus. A high rating. I would Google the company, and what I like to do, like I would do like LifeMD customer reviews, because that's better than what they say. That they're going to obviously find the best reviews possible. Trustpilot and just look at what people say. 76. So this is not good. 17% 1 star. Why would, usually if you're getting 1 stars, people are just not happy. Like we all have, like if you have a restaurant and your food is not good, you're going to get 1 stars. But if you have amazing food and like you make somebody wait like 20 minutes longer than they should have waited, they're probably not going to give you a 1 because you have great food and they kind of like give you the benefit of the doubt. They're annoyed they had to wait. But if the food is average and you made them wait, they're going to probably give you a 1 star because they don't even like the food that much. It's just average. They're going there because it's close. Too many payments on my credit card. Another scam. My initial consultation was on 4. You'll always get people complaining because like you sign up for a doctor and they charge you like $300. And you're like, what happened? Why are you charging me so much? But as long as you know, a majority of like most of your business is good customer service and you're providing good product or service, you get back to people on time. Even if things don't go right, you probably won't get a 1 unless you have a lot of things. So my sister and I both decided another scam company. This is really interesting. Like, how could I'm so disappointed. First month was amazing. Then I ordered my refill. I didn't receive it. When I buy products, like sometimes I see Facebook advertising products, and when I read the reviews, it's like the most life-changing. Like if I'm buying like a workout device, like I read the review sometimes, and it's like the most amazing product in the world. Like my life has changed. I'm starting to think those reviews are fake, like the AI generated, because like sometimes it just like doesn't seem real. I want to see some fake reviews, not fake. I want to see some ones sprinkled in to validate all the amazing reviews. Like a 1 is fine if the 1 is like, I thought they were going to charge me $200, but I got charged $250, like something like that. I don't want to hear like the company scammed me and never sent me a product. I paid $387 for a 6-month membership. Months of charge. Yeah. So how do they have? So you can see their acquisitions probably here. Built a DTC platform. Direct-to-customer platform for healthcare products. They acquired a cloud-based technology platform. So, like once they partner with these companies, like they executed a 20 million collab with MetaFast. Like those types of things help kind of grow the revenue. Yeah, like when I had a tutoring center, I had like 30 or 40 reviews, and they were all 5-star except one gave a 3. But when you read it's obviously the person's, it's not the business. Like you want to read it and it sounds like, okay, if I want to go to a restaurant and I read a 1-star review where they saw, cockroaches in their food, that's not a good 1-star. But if I read a 1-star saying I had to wait a half hour when I got there, I don't care about that. That's just people have their own issues and they have to complain about everything. Ozempic. Yeah, I wouldn't even touch this company. I don't really like the business model. I just think it's. What do you guys think of telehealth? I think it's it's a decent idea. There's some people benefit, but I generally want someone that I kind of can trust and I know well, rather than a strange doctor. I don't know where they are. Where I don't know. I feel more comfortable if it was someone I knew in person. I could go to and see them. And also, there's high competition, and I do see a really. I think telehealth is great to if you have if you have a doctor or hospital you go to in your city or your town, I would like to talk to that doctor once in a while over online instead of going there, especially if it's really bad weather or if I'm not feeling well, like a lot of other things. Telehealth is a great addition to a current hospital or doctor's office. But I don't really like the business so much. I think the competition is kind of high because every doctor's office is going to start doing this or is kind of doing this in a way, whether they're over the phone or they're Zoom with you or like Kaiser. They're really big in California. Like you can talk to your doctor on like it's not a Zoom, but it's like a Zoom call, but it's Kaiser's own system. What do you think of what do you think of the franchise Stretch Lab? I've been going to there, and I was looking into it as an investment. You just go there and they stretch you. You lay on a table. It's a very intimate experience. Like they just stretch you, and you're not going to stretch as well on your own, and chances are you won't stretch at all on your own. Then you go to these places. It's not cheap, and they stretch you. You do feel really good afterwards. I thought it could be a good business investment because it's a franchise. I just don't like that everything is one-on-one. So if as an investment, ideally you want to be able to generate the most revenue with the least amount of expenses. And if it has to be a one-on-one experience, it is hard to do that. Kind of like in a fitness, like if you take a fitness class and there's 30 people in a class and one teacher, those are great margins. But if you're doing a private one-on-one exercise session, how much money can you possibly charge? You can't charge them like $1,000 for an hour. You could charge them maybe $100 the most. So, I mean, it doesn't look bad. Revenue has grown nicely. They're probably never going to be profitable. It's going to take so long. Well, they are profitable in 2023. They $86,000 of free cash flow. I want to see their 10K. Okay, so for 2022, 119 million of revenue. And that grew to 152. And they had a growth in both telehealth and Work Simply. What the hell is Work Simply? Oh, it's a software. What about gun sales? Yeah, ammo is a good stock, right? That's a good company. Work Simply. Work Simply is a platform to like offer services. So they get a lot of revenue from Work Simply. Yeah. No, the ticker ammo, right? Isn't that the ticker? Yeah, POW. I did a video on POW. It looks like they've been really struggling. Well, look how much they went down in 2023. I guess they haven't been doing that well. They peaked in 2021. They're trading pretty much where they IPO'd. They IPO'd it. They're pretty much exactly where they IPO'd. I thought they were going to do pretty well. I guess not. Is there any gun companies that you were thinking about besides ammo? Let's see, Smith & Wesson, a Ruger. They're pretty big, right? Ruger. Smith & Wesson. That's not even that big, 700 million. Vista Outdoor. Is that like for like hunting and camping? Outdoor sports and recreation products. It operates 2 markets. Looks good for the election. It looks pretty good. Ruger. Yeah, Sturm Ruger. It's also under 1 billion. It's a pretty small market cap. Look in 2021, their revenue peaked at 700 million. It's down to 540 million. That's probably why the stocks come down so much. It's down like 50% from its peak was August 2020. You're cynical? Why? I don't see. You didn't say anything cynical. If you want to find a stock that won't go up much in price, invest in a dividend stock. Generally, it's stocks that don't go up much are usually held down by the dividend payment. And stocks that go up a lot usually don't pay a dividend. Well, Costco pays a dividend, right? 0.5%. This is turning into one of my best investments. Costco, I'm up like 140%. I bought it in I think May 2020. At like around 300. I actually have to go to Costco in a little bit. 355. Oh, April 2021. So 355, I got it. This is a good one. It seems so easy now. Oh, why not just buy more? But now I had a strategy way back in like 2013. I was going to just put all my money into Meta and I didn't do that. I probably wouldn't have stayed with it, especially when it was up like 5-6x. I probably would have sold a lot out. But if I would have kept my strategy, I would have been good. Okay, well, is there any other stocks that came up that? Hope it's not a dud stretching me. Yeah, Alex, sometimes you get people that don't do a good job. This guy, I kind of got hurt a little once, so I didn't go back to that guy. It's so easy after the fact to like, look back and say, why didn't I just put more money into it? But the problem is, let's just say even if you have the foresight, the thing is, you just don't know when to sell. Like if you put say when Bitcoin, like say in 2020 when Bitcoin was 10,000, and if you put say you put 100,000 into it, and it went from 10,000 to 60,000. So you'd have $500,000 at this point. And that's just after, 4 months. And then it will come down a lot, and you will go from 500,000 to 300,000. So you're still up. Then you would go to 650,000. So from 100,000 to 650,000. And then it would come back down to little more than your original. It's just so hard. As easy as it seems looking back, it would be so hard to not, you'd be so pissed. You're like, oh my God, I could I could be wealthy, I could retire early, I could have a lot of extra cash. And then a year later, it all goes away and you have no extra cash. So like, at what point do you sell? Like, a lot of people would have, like, if they ever, were up a lot and then they end up losing it all. Once they went up a little bit, even at break even, they might sell it. It's just so hard to not sell and to like, the thing is, if you don't sell, like with Amazon, that's a good example. Agav, what's up? Like, if you somehow like, if you bought it, it's just hard to, I can't even see on this chart actually. Okay, now this is good visual. So if you somehow got IPO, Amazon at IPO, and even if you put in like 1,000, and then your 1,000 is like 100,000 after like just 2 years, and then your 1,000 is 2,000. It's like, it's just so hard to not sell. And at what point do you sell? But how do you know, like, your 1,000 would have been 2 million if you would have just, how do you know? Like, it would be a very painful process. I mean, that's why Buffett's strategy makes the most sense. It's like, you just buy and hold. There's no like thought process, like timing it. I mean, you could sell it if you're really, the company's struggling and not doing as well as you thought. But generally, it's just you buy and hold forever. But that's crazy that Amazon, it was like 8 cents a share at IPO, stock split adjusted, of course. And then it broke through $5. So let's say 10 cents. So it went up 50x in 2 years. And then the dot-com crash, it came back down to like around 30 cents. Now it's 180. Wow. But I'm surprised it went up so much initially. I don't remember that. I didn't know they were such a hot stock initially. I thought they just sold books. I don't know if I could. Okay, here's some 94. So they founded in 94. And they went public in 97. It began selling music and videos in 98 and began international operations in the UK and Germany. So yeah, they did expand pretty quickly to music, video games, electronics, software, toys. And then they had a huge drop, like all the dot-com companies. In 2002, it launched. Wow, Amazon Web Services has been around since 2002. But it was only providing APIs for web developers. So it wasn't that kind of, it didn't evolve that much. I mean, just offering APIs is not really a big deal. What they do now is pretty significant. They're like 38% of the cloud computing market. In 2004, AWS expanded to provide website stats and web crawler data. Elastic Cloud. Okay. Are there any pure play e-commerce companies besides eBay? I want to see, like, does anybody have a really big market cap that's pure play, like above 100 billion? Because eBay is only 28 billion. Any thoughts on this? The end of pure play e-commerce. Okay, I can't figure it out. Maybe I'll look eBay's competitors. So Etsy is a pure play e-commerce, right? They're 7 billion, so they're even smaller than Amazon. AliExpress, Craigslist, but that's not a public company. Because it's not many pure play, because like a Walmart, probably 95% of their sales are in the store, the brick and mortar business. They're closer to a pure play physical retail business, not a pure play e-commerce. I don't even know what Bonanza is. But I mean, compared to a brick and mortar business, e-commerce is much more profitable. These are the internet retail companies. Mercado Libre. I think I did a video on them. That's a good one. Is JD.com, that's a pure play? Baba is probably the closest to pure play. Is that? Oh, it's Uruguay. I thought it was Brazil. It's an Argentine company headquartered in Montevideo. Dedicate to e-commerce and online auctions, making it the region's most popular e-commerce site by visitors. The company has operations in Argentina. I don't want to look at Chinese companies. It's hard to make money on Chinese companies. The VIPs. The Chinese. Wayfair. Chewy is an e-commerce, but it's just for pets. Where I guess Wayfair is also e-commerce. So Wayfair has done the worst in 5 years. Mercado Libre is up 185%. eBay is up 51% in 5 years. That's pretty good. In the past 2 years, Etsy is down. Wayfair, wow, it really came down a lot. I like Etsy. I think there's a lot of potential with Etsy because they're unique. The thing with like an eBay, although I like it, like Amazon can just gobble it up. The thing with Etsy is it's different. People aren't looking for like mass, like buying mass amounts of things or like commodity type products. They want specialized. I don't know about Chinese accounting. I'm not saying that may be true. I just don't like the fact that Chinese stocks, there's really a limit to how much they can go up. So even if you do research on a company, it might not matter because the stock, just the fact that it's in China, it won't go up much. Well, Wayfair came down a lot. I wonder, wow, look at that. This was recently in May, went from 50 to 70. I don't remember that. It must have been earnings. But look how high it got. It got way up, like 350. Like 40 to 350. And then back down, trading between 50 and 100 since that big drop. India is better because India is bigger country, more people. they've taken over, and there's less country geopolitical risk. There's an Indian e-commerce company. Is it Flip? Who's that Indian e-commerce company? Isn't there one? Jumia? Is that it? Oh, that's Germany. Fendi, Dada. Largest Indian companies. Reliance, of course, Reliance. It's a big company. It's a lot of banks. Infosys. Is that what I was thinking of? Infosys. It's a big company. 72 billion. Unilever. But Indian stocks, how do they perform relative to the is there an index for Indian stocks? Does anybody know, is there an index that tracks Indian stocks? The S&P BSE Sensex. Here we go. I don't know. I'd like to see what's. Okay, so I guess this is just tracks Indian, the stock market in India. What's a good index to track the Chinese market? Well, look how much Indian stocks have gone up. Indian stocks have gone up 22x since 2004, while US stocks 5x. They really performed well. Indian. Okay. Well, good stream. I hope. What is that? ASX Fendi? Findy Limited, is that a that's a small company, 180 million. Well, it's struggled pretty bad. Okay, well, thanks for commenting, everybody. I might do a stream tomorrow. Enjoy the rest of your day. Enjoy your Memorial Day weekend. And I'll talk to you later.